Every major money system you use today, digital payments, mobile wallets, biometric ID, instant transfers, financial surveillance, is being tested somewhere right now. Not in Silicon Valley. Not in London. In Africa. This isn't just an African story. It's a glimpse into how the global money system really works when institutions are weak, rules are rewritten, and survival matters more than theory. Africa isn't behind the system. Africa is where the system is being stress tested. And what's happening here tells us exactly where global finance is headed next. To understand why Africa became the world's largest financial experiment, you need 3 facts. First, over 60% of adults were unbanked just a decade ago. That's hundreds of millions of people, excluded from formal finance. Second, weak trust in institutions. Many governments inherited colonial banking systems designed for extraction, not inclusion. Third, high mobile penetration. People skipped landlines, skipped desktop banking, and went straight to phones. In the US or UK, banking evolved slowly, regulation first, innovation second. In Africa, survival came first. Rules came later. This isn't chaos. It's what happens when the global money system collides with reality. In Kenya, a service called M-Pesa launched in 2007. It wasn't supposed to replace banks. It did anyway. Today, over 50% of Kenya's GDP flows through mobile money. No checking accounts. No credit cards. Just phones. Compare that to the US, where mobile payments still sit on top of banks. In Africa, mobile money became the bank. This isn't just innovation. It's a preview of what happens when trust shifts away from institutions and toward networks. In Nigeria, Ghana, and across West Africa, millions rely on POS agents. A POS agent is a small roadside merchant who provides cash withdrawals and transfers using a bank terminal. To regulators, this looks risky. To users, it's the most reliable part of the system. This mirrors history. In 19th century America, private banks issued their own currencies. In Africa today, trust flows through people, not logos. The global system calls this informal. But informal systems are how finance survives when formal systems fail. Here's where the experiment gets dangerous. Global finance runs on rules, AML, anti-money laundering, KYC, know your customer. These rules are written in Washington, London, Brussels, but enforced in Lagos, Nairobi, Accra. When a Nigerian fintech gets flagged, U.S. correspondent banks can shut them out of the dollar system. No appeal. No local context. This isn't about Africa breaking rules. It's about what happens when global rules meet unequal power. The same systems exist in Europe. Africa just feels the pressure first. Every time an African fintech grows, it eventually plugs into Visa, Mastercard, or Swift. The rails are global. The control is centralized. This is called platform dependency. Africa didn't design the rails. But Africa depends on them. The same is true for Europe. The difference is leverage. Africa shows us what happens when you don't own the infrastructure but still carry the risk. This isn't a regional problem. It's the future of global finance. Africa's financial experiment creates winners. Faster innovation, lower transaction costs, new financial identities. It also creates losers. Sudden account freezes, exclusion by algorithm, entire economies vulnerable to decisions made elsewhere. This is not an African failure. It's a global preview. As money becomes more digital, more programmable, more centralized, everyone moves closer to Africa's reality. The question isn't why is Africa like this? The question is how long before everyone else is? Africa is not catching up to the world. The world is catching up to Africa. This isn't just an African story. It's the clearest window we have into how money behaves when pressure replaces privilege. And if you understand Africa, you understand the future of finance.